Your first investment can either accelerate your startup or sink you. Here's how to pick a winner. Hey everyone, I'm Alex. I started my journey with a modest $5,000 personal portfolio and turned it into a $250,000 runway fund, all while bootstrapping 3 different companies. Looking back, choosing that very first investment was the single biggest, most nerve-wracking decision I ever made. The stakes are incredibly high when it's your own money and your company's future on the line. Today, I am going to walk you through the 3 exact frameworks that I use to take all the guesswork out of it. These aren't just abstract theories. They are practical, battle-tested strategies that will help you make smart, confident decisions with your capital. So, if you're a founder trying to figure out where to park your cash to make it work for you, you're in the right place. Let's get into it. First up, and arguably the most critical framework, is aligning your investment with your business timeline. This sounds simple, but it's where so many founders go wrong. They chase high returns without considering when they'll actually need the cash. Here's what you do. Grab a whiteboard or open a spreadsheet and map out the key milestones for your startup. Be realistic. How long until you have a minimum viable product? Maybe that's 12 months. When are you planning to raise your Series A? Let's say that's 24 months out. This timeline is your investment roadmap. Now, you match your investment's liquidity to that timeline. Liquidity just means how quickly you can turn an asset into cash without losing a bunch of money. If you need that cash in less than 12 months for payroll, marketing, whatever, you should not be anywhere near volatile assets. You need stability. Think high-yield savings accounts or short-term bond ETFs. The returns won't be massive, but that's not the point. The point is capital preservation. Your money will be there when you need it. On the other hand, if you have a time horizon of more than 2 years for a specific chunk of cash, you can afford to take on a bit more risk for a higher potential return. This is where you might consider broad market index funds. The key takeaway here is this: aligning your investment horizon with your business needs prevents a forced sale. The last thing you want is to be forced to sell your investments at a 20% loss just because you need to make payroll next month. That's how you turn a small funding gap into a catastrophic failure. Plan your timeline, match your assets, and you'll sleep much better at night. Okay, let's move on to the second framework, which I call the business skill mirror strategy. This one is all about leveraging your biggest unfair advantage, your domain expertise. As a founder, you're deeply immersed in a specific industry, whether it's software development, e-commerce, biotech, or something else. You understand the nuances, the key players, the emerging trends, and the underlying technologies in a way that a generalist investor never could. So, why not use that knowledge to your advantage? The strategy is simple. Invest in a sector you already understand inside and out. For example, if you're a developer building cloud infrastructure tools, you should be looking at stocks in the cloud computing space. You can read a company's technical white paper and actually understand it. You can evaluate the quality of their product and the strength of their engineering team. This allows you to assess the fundamentals of a potential investment much faster and more accurately than someone who is just looking at a stock chart. You can spot the real innovators versus the companies that are all marketing hype, but it gets even better. This strategy creates a powerful synergy between your startup and your portfolio. The insights you gain from researching your investments can directly inform your own product decisions and business strategy. You might discover a new competitor, identify a new market opportunity, or learn about a technological shift before it becomes mainstream. Your portfolio becomes a source of competitive intelligence. For me, investing in marketing tech companies while building my own SaaS gave me incredible insights into customer acquisition strategies that I then applied to my own business. It's a feedback loop where your work makes you a better investor, and your investing makes you a better founder. Don't underestimate the power of sticking to what you know. Now for our third and final framework, perfect for those who are just starting out and feeling a little overwhelmed. It's the start with $100 cost averaging fund strategy. The biggest barrier for many new investors isn't money, it's analysis paralysis. You spend weeks researching, reading, and watching videos, but you're so afraid of making the wrong choice that you end up doing nothing. This framework is designed to break that inertia and get you in the game with minimal risk and minimal stress. Here's the plan. First, pick a low-fee, total market index fund. Something like VTI, which tracks the entire US stock market, or SPY, which tracks the S&P 500. If you want global exposure, you could look at a total world ETF. The key here is low fee and broad market. You're not trying to pick individual winners. You're buying a tiny piece of the whole economy. This diversification instantly reduces your risk. Second, automate a regular contribution. I suggest starting with $100 a month, but it can be whatever you can comfortably afford: $50, $20, even $10. The amount is less important than the consistency. Set up an automatic transfer from your bank account to your brokerage account every single month. This is called dollar cost averaging, or DCA. So why is DCA so powerful? Because it smooths out volatility and removes emotion from the equation. When the market is down, your fixed $100 buys more shares. When the market is up, it buys fewer shares. Over time, this averages out your purchase price and helps you avoid the classic mistake of buying high and selling low. More importantly, it teaches you the single most important habit of successful long-term investing: discipline. You're building a process, a routine. You'll learn to ignore the daily noise of the market and focus on consistent, long-term growth. This is how you build both wealth and the right investing mindset without getting bogged down in endless research. It's the simplest, most effective way to start your investing journey. So, to quickly recap, we've covered 3 powerful frameworks to guide your first investment as a founder. First, align your investment with your business timeline to ensure cash is available when you need it. Second, use the business skill mirror strategy to leverage your unique industry knowledge for a competitive edge. And third, start with a simple, automated dollar cost averaging plan into a broad market index fund to build discipline and overcome analysis paralysis. Each of these strategies serves a different purpose, but together they create a robust foundation for building a portfolio that supports, rather than jeopardize, your startup's growth. Now, I want to hear from you. Which of these 3 frameworks will you try first? Are you going to map out your timeline, lean into your expertise, or start a simple DCA plan? Comment below and let me know. I'll do my best to reply to as many as I can with a quick feedback note. And of course, if you found this guide helpful, please give this video a like, subscribe to the channel, and hit that notification bell for more founder-focused investing guides just like this one. To help you stay on track, I've created a free first investment checklist. You can download it using the link in the description below. Also, consider hopping into our Discord community. It's an amazing space where members post their monthly DCA screenshots, share what they're investing in, and get peer review from other founders. The link for that is also below. Thanks for watching, and I'll see you in the next episode of Business Finance 101.